Introduction to risk and uncertainty. Risk and uncertainty are two fundamental concepts that play a crucial role in decision making, practically in the fields of business, economics, and personal finance. Although these terms are often used interchangeably, they represent distinct ideas. Risk is associated with situations where the outcomes are uncertain, but probabilities are different. Outcomes can be quantified or estimated based on valuable data. In contrast, uncertainty refers to situations where it is possible to predict future outcomes or assign probabilities due to a lack of information, and this chapter will delve into these two concepts, exploring their differences, their similarities, and how they affect decision-making processes in both business and personal contexts. Number 2. Defining risk, a quantifiable probability. Risk refers to situations in which the likelihood of different outcomes can be determined based on available information. It is an inherent part of any decision-making process, especially in economic activities like investing, managing a business, or making personal financial decisions. For example, when you invest in stocks or bonds, you are dealing with risk because you can estimate the potential outcomes. For example, the probability of making a profit or incurring a loss. These probabilities can be calculated by using historical data, statistical models, and forecasting techniques. In this sense, the risk is something that can be measured, managed, and mitigated using various tools such as diversification, hedging, and risk analysis method. Number 3. Defining uncertainty, the absence of information. On the other hand, uncertainty arises in situations where there is a lack of knowledge or data to accurately assess the likelihood of future outcomes. In environments marked by uncertainty, decision makers are unable to predict that will happen next because the necessary information is either unavailable or impossible to gather. For instance, a business operating in a politically unstable region may face uncertainty because the political landscape is constantly changing, making it difficult to forecast future politics or regulations. Similarly, in personal finance, there are many to be instances of uncertainty when external factors such as global economics, crises, or natural distress create unacceptable and unpredictable situations. Unlike risk, uncertainty cannot be easily quantified or predicted, making it much more challenging to plan for. Number 4. The distinction between risk and uncertainty. The key difference between risk and uncertainty lies in the ability to assess probabilities. Risk is characterized by the ability to predict and quantify outcomes based on available data and statistical analysis. For example, investors can calculate the risk associated with a specific asset by looking at its historical volatility or by using models like value at risk to estimate potential losses. In contrast, uncertainty exists in situations where such predictions and measurements are not possible. Since uncertainty often involves unknown variables or unpredictable events, it requires decision making based on intention, judgment, or scenario planning rather than strict probability force trading. This distinction is important because it shapes how business, investors, and individuals approach decision making in different environments. Number 5. The role of risk in business, anticipating and making decisions and risk. In the world of business, risk is an unavoidable reality that organizations must navigate in order to succeed, whether starting a new company or managing an established firm. Entire producers and managers constantly face various types of risk. For instance, they may face market risks, such as changes in consumer demand, competition, or fluctuations in commodity prices. Additionally, operational risks such as production delays or supply chain disruptions that can pose significant threats to a business's profitability. Financial risks, including changes in interest rates or currency change rates, can also have a major impact on business operations. Businesses that effectively manage these risks can thrive, while those that fail to do so may suffer financial losses, legal penalties, or reputational damage. Number 6. Managing risk in business, techniques and tools. Effective risk management is essential for the long-term successes of any business. There are several tools and techniques that businesses can use to identify, assess, and mitigate risk. The first step in risk identification, which involves recognizing potential risks that could impact the organization. This can be done through market research, SWOT analysis, which assessing strength, weakness, opportunities, and threats, and conclusion that industry expects. Once risks are identified, business can assess their likelihood and potential impact using risk assessment models. After this, risk mitigation strategies can be implemented, such as diversifying product offering or purchasing insurance, implementing contingency plans, or hedging financial risks. While businesses can manage and reduce many risks, certain external factors such as changes in laws or economic conditions may introduce uncertainty that is beyond their control. Number 7. Risk and investment. Quantifying financial risk. Investment, particularly in financial markets, is inherently associated with risk. Unlike business risks may involve operational or market uncertainties, investment risk is often more quantifiable. That investors use various tools to assess the risk of different assets such as stocks, bonds, and real estate. One common tool for measuring investment risk is standard deviation. In the assessed returns, the greater the standard deviation, the higher the risk. Additionally, investors can assess risk using metrics like beta, which measures the asset's volatility relative to the market, and the Sharpe ratio, which evaluates risk-adjusted returns. Risk in investment can also be mitigated through diversification, separating investments across different asset classes or geographic regions to reduce the impact of any single investment's poor performance. Number 8. Understanding risk tolerance, how personality affects risk decisions. Risk tolerance refers to the degree to which an individual or organization is willing to accept risk in pursuit of potential rewards. Risk tolerance varies widely among individuals, and it is influenced by a variety of factors. One key factor is financial security. Individuals with stronger financial resources are often more willing to take on higher risks because they believe they can absorb potential losses. Additionally, personality traits play a significant role in risk tolerance. For example, some people are naturally more risk-averse and prefer stable, low-risk investments, while others are more risk-seeking and prefer high-risk, high-reward opportunities. Personal experiences are also shape risk tolerance. Those who have bad previous successes in high-risk investments may be more inclined to take in similar risks in the future, whereas those who have suffered financial losses may become more cautious. Number 9. Psychological and social factors influencing risk-taking. Psychological factors, including emotions and mental states, play a crucial role in determining an individual's willingness to take risks. Studies have shown that people are generally more willing to take risks than they are in a positive emotional state, such as feeling confident, happy, or excited. Conversely, individuals who are anxious, depressed, or fearful are more likely to avoid risky decisions. Additionally, social and cultural factors can influence risk tolerance in societies that emphasize individualism, competition, and personal achievement. People may be more inclined to take risks in pursuit of success. In contrast, cultures that emphasize social harmony, security, and risk aversion may foster more cautious behavior. Number 10. Conclusion: managing risk and uncertainty for better decision making. In conclusion, risk and uncertainty are two distinct but interconnected concepts that significantly affect decision making in business, investment, and personal finance. Understanding the difference between those two can help individuals and organizations make more informed and strategic decisions, while risk can be measured and mitigated using various tools and techniques. Uncertainty often requires decision making based on judgment, intuition, and scenario planning. By acknowledging and addressing both risk and uncertainty, businesses and investors can better navigate an unpredictable world and make decisions that enhance long-term success and stability.